your position, the futures markets in silver are as much as $2.5 or $3 back of spot. And so that's putting the dealers in a horrible position. A lot of them are freezing up. They don't want to play in this market. There is no liquidity in this market. So it's something that ultimately will hopefully resolve itself, but I've never seen a market quite like this. I've always told people, watch how fast this changes, where a couple of weeks ago you could buy silver eagles for under $4 an ounce. Now you're going to pay anywhere in America approaching $8 an ounce, and it's just beginning. So yeah, I think that there are pivot points everywhere. The LBMA, the COMEX, the big wholesalers, the bullion banks, the big refiners, none of them want to do anything because the price is so far back on spot. I mean, on the futures market, so far back of spot that it's creating a near impossible environment to work on. We've talked about that now for a long time, haven't we? And we've been talking about the bleed down in the London inventories. And as a result, we're seeing massive backwardation. And it's rare in silver. It signals urgent demand, and it signals depleted inventories. It signals a systemic shortage of deliverable bars and a liquidity collapse. We've seen a $3 premium to New York futures, a spread that hasn't been seen since 1980 during the Hunt Brothers squeeze, and a borrowing stress cost where in order to borrow silver, a lease rate it's called, it spiked above 100% annualized. That's worse than the 1980 panic. No one's ever seen anything like that. A lease rate that is normally 1% or less is now over 100%. This is putting some of these short traders in a very, very dangerous, precarious, and quite frankly, frightening position. And you know, I don't know. This isn't even manipulation. This is firms liquidating positions due to financing costs and exploding volatility and illiquidity. This is something that I don't know if it doesn't get better anytime soon. I think fireworks will be the name of the game.
Historically, borrowing silver, the lease market, carries a modest cost, perhaps 1% or less. Today, that equation is shattered. Lease rates have surged into double and even triple-digit territory, putting immense pressure on traders who are short or leveraged. Some market insiders report that London's one-month silver lease rates have climbed past 34.9%. That means holding a short position carries a prohibitive cost. For many, maintaining margin or financing delivery becomes untenable, and that portfolio strain can cascade quickly.
Premiums are beginning to shoot up dramatically, especially on Eagles. I noticed that almost every dealer in America now is on their quantity discount is north of $7.50 over the price of silver. And I've mentioned this to you so many times that what is available in abundance today, in the blink of an eye, can change. And we're seeing massive premiums on silver eagles, huge premiums on gold and gold eagles and gold buffaloes. Then again, I've never seen a market like this that has reacted as fast as this has. At the same time, I don't know that I've ever seen a market where gold goes up over $100 in a day and silver is moving up 3 and 4% in a day. We're seeing tightness in platinum as well in London, where the head of the Japanese Tocom exchange has been telling us for weeks that they're trading over 3 million ounces a day of spot contracts, yet there's no platinum available for delivery. This is something that I think the mainstream media that is talking about it and trying to convince us a lot of bars are heading back to London, I think that's BS. I don't believe that at all. I think it's spin doctoring. I think this is going to get worse before it gets better.
The crux of the crisis lies in the divergence between paper contracts, futures, forwards, and physical metal. The shorts, those who must deliver physical silver, are increasingly unable or unwilling to bring metal into the delivery chain. In effect, real inventory is being hoarded or locked away unavailable to satisfy futures obligations. The structure now favors long holders. They may demand delivery, but only shorts who can deliver provoke metal movement. This breakdown shows just how fragile the link between promise and possession has become.
They might be right. I don't think they are. Be leery of the guy who says this time is different, but it feels different. The physical supply just isn't there right now. And now you're seeing margin stress hitting the paper market. Margin calls are going to start going out. This means that all these leveraged players are under massive pressure. This is a hallmark of illiquidity and forced liquidations. I think that the only way to smooth out the uncertainty of should I wait or should I not is to cost average. Because one of these days, as we've been saying for a long time, the wolf cometh. Me, you, the little boy who's cried wolf on the front page of the book. At the last chapter, the wolf comes. And is this the wolf coming? I don't know. It feels like it. And this is a problem when the currency that we call the dollar feels more like a melting ice cube than it does a store of value. And I think the world sees that. And there is a real push to get the real thing instead of rolling over futures contracts. And I really want to hammer it home that this is the big noise about shipping silver to London isn't strength. It's a cover story to calm nerves. If supply were fine, there wouldn't need to be a PR push that we're seeing right now. I don't know. This tells me it's just getting going. We were told it was tariffs. I said from moment one, it's not tariffs. It's reshoring. What you have right now are sophisticated investors who have been well ahead of the curve, who have been bringing metal home here. And yes, there is an incentive when the price of the spot market is $3 ahead of the futures. Yeah, there is an incentive to move some of it back to London, and you'll see some of it. But this is not the big push that we saw bringing all that metal here. No, this is not what that is. You'll get a few rogue traders. They'll try to capitalize on it. But what this is the beginning, I believe, of watching the LBMA lose supremacy and legitimacy right in front of our eyes.
This dislocation isn't limited to raw bars. Retail products like silver eagles, buffaloes, and other coins now command enormous premiums, sometimes $7, $8 over spot in the U.S. Dealers warn that what seems abundant one day can vanish the next. Meanwhile, gold markets, platinum, and other precious metals are showing similar strains. The conventional hedging mechanisms are under stress. To lock in inventory, dealers must buy at spot, while hedging via futures often offers much lower prices. That arbitrage squeeze disrupts market participation and forces many to stand aside.
Seeing no liquidity in the marketplace at all. I mean, really, you're seeing none. You're seeing a lot of the big players are sitting on the sidelines. And, I think that what you have in essence is that the shorts are not really able to deliver. And that's the problem. There's a lot of shorts who don't want to deliver or can't deliver. And if that happens, it's the longs. Everyone thinks the longs are the ones that initiate the delivery, but that's not what it is. It's the shorts who have to be able to deliver. And it's not the longs who control delivery. You can think of it like a coat check at a theater. The long is the person holding a ticket who wants their coat back, but the coat doesn't move until the attendant, the short, hands it over. And on COMEX, it works the same way. And if someone already has silver sitting in the vault, they can't just pull it out. First, they have to check it back in by becoming a short in the delivery month. And then they use their long position to stand for delivery, which triggers the metal to move. So while the longs have the right to take the silver, it's the shorts who actually make the process happen. And the bottom line is the sellers with physical silver in the system are the ones who control how and when metal is leaving COMEX. And so when we see more shorts piling on right now, this is actually a very bullish thing for silver as far as I'm concerned. And so, we're talking stress in the COMEX. We're talking stress in the LBMA. We're talking stress in the dealers who are frozen right now because in order to lock things in as a dealer, you're buying at spot, but
Such deep backwardation hasn't been seen since the Hunt era of 1980. Analysts draw parallels to other periods when physical demand overwhelmed paper markets. Technical chart patterns also hint at a long-term breakout. Some observers point to a 45-year cup and handle in silver pricing, suggesting potential for dramatic upward repricing. If this structural shift holds, silver may break into triple-digit territory, not as speculative frenzy, but as a reversion to fundamental value.
in order to hedge your position, the futures markets in silver are as much as $2.5 or $3 back of spot. And so that's putting the dealers in a horrible position. A lot of them are freezing up. They don't want to play in this market. There is no liquidity in this market. So it's something that ultimately will hopefully resolve itself. But I've never seen a market quite like this. I've always told people, watch how fast this changes. Where a couple of weeks ago you could buy Silver Eagles for under $4 an ounce. Now you're going to pay anywhere in America approaching $8 an ounce, and it's just beginning. So yeah, I think that there are pivot points everywhere. The LBMA, the COMEX, the big wholesalers, the bullion banks, the big refiners. None of them want to do anything because the price is so far back on spot. I mean, on the futures market, so far back of spot that it's creating a near impossible environment to work on.
For investors caught in the middle of this squeeze, the path isn't simple. Liquidating now can lock in losses because futures bids are well below spot. Holding may incur financing stress if leveraged. Many analysts suggest dollar-cost averaging physical exposure rather than timing the market's peak. The broader lesson: demand for real metal is rising as confidence in paper claims erodes. Banks now forecast silver at $65 per ounce or higher as supply deficits deepen. This moment may rewrite how markets treat physical precious metals versus paper derivatives.
If you try to sell right now, you're going to get $2 to $3 back a spot as the price. The dealers can't hedge it otherwise, and so that's a situation that I've never seen before, ever, to this degree. It means that if you're selling, you do not want to sell right now. You just do not want to sell. And this is, look, gold's up 53% on the year. Silver's up more than that. But I just think that this is a market that's broken right now. The silver market is broken at the moment. We'll see how it all plays out. But this is a game where I think the desire to take paper promises is disappearing, and the world is saying we want the real thing, and that's putting some major stress in the marketplace. And the players who are trying desperately to not let the price go away from them by selling futures have created a massive backwardation that I've never seen anything even close to it. So in other words, you want to sell something right now, the bid price right now, let me look and see. Right now, spot price is 52.08 or thereabouts, but the futures price right now is $50.56. So it's coming back a bit. It was almost $3. Now it's like $2.50. Or let's see, 50.56 minus what? 52.08. So it's at $1.60. It's coming back a bit, but your bid price would be based upon 50.56 as the futures price. Yet if you're buying, you're paying on 52.08 ask price. I have never seen anything like that. And I would say to people that this will change. The spot and the futures price will get more in line. But what it really means is that this is not a seller's market at this point. Hold tight. Wait till this rectifies itself. But I could see a massive spike in the spot price as you see margin calls and the fallout from global margin calls where big players have to, the lease rate used to be 0.5%. Now it's over 100%. So if you need to get metal to cover a position or to short, Well, you're paying 100% premium. That doesn't work. The market is broken, and it could very quickly put some big players underwater very, very, very quickly.